My guest today is Samir Shah, co-founder and CEO of Ledger Investing, former chief reinsurance officer and head of capital markets at AIG. Samir started his career as a pension actuary and management consultant. Samir, welcome to the show.
Thanks. Thanks very much, David.
First question. So insurance is a promise to pay and solvency regulation. And here I'm lumping together the regulators themselves and also rating agencies, which I think jointly administer the solvency regulation in a kind of informal sense. They exist to ensure that these promises to pay are met. Now, to increase liquidity, and we can get into that if you'd like, unrated insurance and reinsurance sits outside of that system. So I'm wondering, should insurers be worried about the promise to pay?
Yeah. So, there's, it's a good question. There's a short technical answer to this, but I think there's a longer answer that is more fundamental. So the short technical answer is this. Yes, insurance is a promise. However, it's, as you know, most insurers reinsure, and so they get promises from other people.
Yeah.
And so it's promises that are built on promises, and the reinsurers do retro. So it's like promises built on promises built on promises.
Yes.
And hopefully regulators are managing that, but it's really a network of promises, and the real risk to a consumer or to a commercial buyer is whether this network fails in some systemic way, and we've seen stresses of that once in a while, but generally that, notwithstanding the fact that it's promises built on promises, it's performed pretty well for a long time. And I recall reading, I think it was an Aon report that said that generally it acts like a AA credit, because even when insurers fail, which they fail more frequently than AA credit, somebody comes in and buys them up and sort of honors their obligations. Okay, so that's what they have now. Promises built on promises, but it's worked pretty well. Now, when you go outside of that into the ILS market, it's not really for liquidity. It's to tap into a deeper pool of capital. And so the short technical answer to your question is that when it goes there, it's not really outside the system, but because it's not a rated balance sheet, they fully collateralize their obligations. So what's better than a promise is to say, here's the money, the maximum amount of money that I could ever owe you, and here it is sitting in a trust, and you can draw on that money anytime you want without my permission to pay your claims. That's actually much better than a promise. So in that sense, in that very narrow sense, for a consumer, for the insured, if I know that I'm getting a promise from an insurance company that's backed by real collateral sitting someplace rather than another network of promises, that's safer for me. Let me pause there. That's the short answer.
So I want to push on one part there where you push back on my characterization of liquidity being the problem. So I want to see. I'm going to keep going on that for a sec, and then we can round back. We will spend an entire hour talking about unpacking your answer there, Samir, I suspect, which is going to be wonderful.
This is actually, David, I really think this is a very fundamental. I'm glad you start from the insured perspective. Because you're right, I think we could spend hours on, from that perspective, what's happening in the market and whether it's a net good or neutral or bad.
So away we go. Now, I think liquidity is important. I think liquidity is critical because if I think about the capital providers, right, these large pool of capital, their problem is they're saying if I want to write insurance risk, then the regulator keeps it, and it's very hard to get it back out again, right? And so if I'm going to capitalize a liability policy, or even a property policy for that matter, there's a world in which a consumer doesn't want to say, it doesn't want to commute their policy, right? So they don't want to say, I'm done. If anything happens in the future, you don't have to pay anymore. So consumers want, they buy a promise, and the promise is good forever, right? If asbestos happens, 50 years from now, they can still claim. And so the investors, though, don't like that because they're saying, well, I have customers who want their money back at some point. Yeah. And so I need to be able to provide that kind of liquidity to them. So to me, the real, call it the financial innovation of collateralized reinsurance is to provide liquidity in a certain sense for insurance liabilities.
Yeah, I see your point, but I think you're also pointing out that they want their money back, so they're not it's providing liquidity to the investor at the expense of the insured, is what you're pointing out, right?
Yep.
I think that, uh, however, what's happening is that that initial promise um, is still the one that the insured has to rely on, and it's the network of promises behind them. And so what happens is when the insured needs to offer liquidity to somebody, they're essentially saying, okay, I'm taking back that risk. Now it's my
Right.
promise. It's always been my promise. It's always going to be my promise. Now, to what extent am I going to rely on other promises? That's really where the liquidity comes in. When you go to a reinsurer, that promise can be good forever. Technically, it's good forever, but practically, it's as good as long as the company is solvent. And on the other side, it's as good as long as the investor doesn't want their money back. If the investors want their money back, that's great. So I take that promise back. And so this isn't an issue that should affect the insureds, because what's happening is that some portion of the forever part is being capitalized by money sitting in a trust, whereas currently none of it is being capitalized by money sitting in a trust. Right? All of it is just built on promises. And here, there's no more promise. So even having that for a short period of time is better than not having it at all.
So let me see if I can summarize this. So we have two models. One where you have an insurance balance sheet, and that insurance balance sheet does not have a dollar for every dollar of limit, right? Because that would be too big. They write the limits, the ratio of premium to limits is, something very large, limits to premium. And so you can't really do that for most insurance policies. But the regulator says, okay, we're going to break the rules. I call it the miracle of insurance, right? The miracle of insurance is the accounting rules say if you have an obligation, you have to put money in your balance sheet to fund that obligation, to finance that obligation, right? And the insurance regulator says you don't. We're going to ask an actuary what they think is going to happen, and that's how much you put in the bank, right? And so there's still money there, and it's not in a trust so much, but let's call it equivalently restricted to a trust. So the whole point of the trust is that it mirrors the restrictions and capital flows of an insurance company, and then we just watch that to make sure that they're not screwing up their estimates, or we have the actuary sign stuff and they get in trouble if they mess that up. We have this independent body, kind of quasi-independent body being actuaries and regulators. So they're all kind of watching each other, as you say, the network of trust. And then we have this sort of, outside of the system, we have this collateralization of the limits, which, as you point out, is probably better because there's no need to have an actuary tell you whether it's solvent or not. It's like, it's all there. The money's in the bank for property. But the problem, though, is that, as I'm pointing out, is that it ends. Like, they shut it down. Like, we closed if no hurricane happened, we pull the money out of the trust, and now there's nothing left. And there's, I've been part of a lot of these collateralized reinsurance negotiations where it's like, when do you actually call it quits? And then,
Yeah, I think we're okay. I see your point, but I think we're mixing a couple of different dynamics here. So let me try to generalize to get all of these dynamics in. Let's say that in that insurance company that they have $100 of capital that they have to maintain, and you characterize it as sort of a miracle, but it's really based on the law of large numbers, really, right? And if not for the law of large numbers, nobody would be insured.
right.
So it's a net good thing for insureds that there is such a dynamic as a law of large number that allows them to say only hold $100, even though all my limits add up to 50 times that. So okay, now they have $100 of capital. Now the question is, what is the best place to get that $100 of capital? So one choice is, and the choice that the industry has used for a long time, is it's going to be permanent capital, because after all, it's a promise. So it's nice to say that I have permanent capital, okay? But as we just agreed that that $100 of capital, sometimes what they do is say, I'm not going to keep $100 myself. I will take $40 of that and get it from promises from other insurance companies
Yep.
who are also going through these law of large numbers exercise and holding a certain amount of capital, and quite likely less than 40. Right? So now I have $60 of capital. I'm relying on $40 of capital from somebody else, a promise. Okay? Now I could, instead of working on a promise, I could go to the ILS market and have $40 of capital sit in a trust. And you're right, there's an end to that. But essentially, when that ends, at any moment in time, when that ends, unless I'm renewing it, I have to have $100 of capital again. Okay, so and that's really the way the industry works. Is they're always supposed to have enough capability to have the equivalent of $100 of capital. So the question isn't so much when does that end? It's like if you created a Venn diagram of the amount of capital, let's say on the y-axis, and the x-axis is like time. So you need a certain amount of capital for each moment in time. For the amount of business you write, it decreases over time. And you say, well, for a portion of that, I'm going to get it in the ILS market. And it means that I've planned for not having that at some point, and I'm taking care of the rest of the capital. The insured is not worse off when they can go to the ILS market. They're better off in two ways. One is that, first of all, this promise is more reliable. The second thing is, the whole reason to do this is because there's more capital and it could be potentially cheaper capital. And so let me introduce that dimension of it so the overall perspective of what an insured should care about. What's happening right now in the industry, or happened for a long time, is that there's I don't know, somewhere between $1.5 and $2 trillion of capital in the global property casualty industry, depending on how you count, capital that's fungible over life and property casualty, and it's split over thousands of balance sheets around the world. And notwithstanding the fact that there's $1.5 to $2 trillion of capital, there is a lot of risk that is still uninsured. And you can see, California, there's only 12% of the market actually buys earthquake insurance, even though there's, people say there's a lot of capital. There are many institutions, Swiss Re or UN, others, who monitor the economic loss versus the insured loss, and there's always a huge gap there, and that gap is increasing, what they call the protection gap. And the reason for those gaps, which all hurt all of us as consumers of insurance, is that we're not able to insure a lot of things at an effective price. And so the issue is the cost of that capital. And when you go beyond these several thousand balance sheets that are highly concentrated, and when you have limited, when you have these small balance sheets, as the risk goes up, as the more you write, the cost increases exponentially. So if you can tap into the capital markets, which is a much, much deeper market and can better absorb these concentration, as you write more risk, the cost doesn't go up exponentially, it goes up linearly. And so what that should do is open up the possibility for offering insurance at more economic rates. So the net plus to an insured is, first, they have a promise, but they also have a price for that promise. So one thing is they want to make sure the promise is kept. But the second thing is they want to be able to insure more at a good price. And I think the capital markets does both of those things, because for the portion of the promise that the capital markets are taking on, which is not only amount but also time. Like, I'm going to give you $100, but I'm going to give it to you for a year, and then I want it back. So for that portion, it's more reliable and it's cheaper. On a
So
long-term basis, it could be cheaper.
let me come back to an earlier point, and we're going to rake back over all this again too. Okay, we're going to keep doing this because there's just so much here, I think, and I've always had a few things that have bothered me about this. And so let me tell you one thing. So let me try and summarize something you said a little bit earlier and come back to it, and let's see where we go. So you mentioned earlier that when you write a promise as an insurance company, you don't necessarily capitalize that promise 100% out of internal capital. You're not raising equity to fund it all. You're buying reinsurance to offset some of that capital. So reinsurance is lowering the amount of capital you need, and therefore reinsurance is a form of capital. And then you're making the important observation, that the reinsurers are doing the same thing. And so they actually don't have, they don't have as much capital to back that obligation to you as you would have had yourself. Because, and here's, the source, we didn't use the word yet, but the source of this, what I'm calling the miracle of insurance, is diversification. So diversification is a source of capital. So you're saying the premium from this side and the premium from that side over there, they offset each other. Only one of them can go wrong. Therefore, we can think of like the premium ballast that we have as a kind of a source of capital itself, right? Because that's what's primarily backstopping the claims is our premium portfolio. And so if you can use diversification as a source of de-risking of capital, therefore, right, then you need less of it, right, and on it goes. And so what's amazing to me about this is that the capital markets, and we're going to come to this cost of capital question again in a second, but it's amazing to me that they are capitalizing the insurance liabilities way more than an insurance company is. Like there's I mean, by an order of magnitude, right, more capital is coming into the system. Although the trade is that it's not in there permanently, right? So it's in there for a temporary period of time, and we are sort of like implicitly talking about your business here all over the place. I know that the idea is right because one of the things that you guys are innovating on is how and when do you actually need that much capital? And because there's 10x more capital here, well, that all sounds great, but you don't need that for the entire length of the policy's liabilities because it tapers off. You get more certainty, and we should express that certainty in the form of a reduced capital need. So to me, like the magnitude of capital has just gone so far up. And again, my feeling is the trade for that is that you're introducing some liquidity, and they want to be able to pull it out in exchange for all that capital.
So I think. My sense is that most of these comments are a function of the current ILS market, which is the cat bond market. And so it's really about cat risk and how it works, which I don't think is the model for the potential for capital markets. And so let me explain the distinction between these two things. The current market was primarily motivated by risk management objectives. Whereas the huge opportunity that I'm talking about for insureds is from a capital management perspective. And the difference is this, that from a risk management perspective, what happens is an insurance company takes on risk and says to itself, well, I don't like the earnings volatility profile of my company. I have a lot of concentration here, and so I would like to decrease that earnings volatility, and I will then reinsure it to somebody else. And so they usually buy sort of excess of loss type covers in order to decrease that volatility. And when they do that, they are actually end up paying more than holding it on their balance sheet from a cost of capital perspective. But they're willing to do that because the net effect of that is lower return and a lower risk. And that's the trade-off that all the insurance companies make. And so that's the risk management perspective. And so when you buy cat bond, or when you sponsor a cat bond, you're doing a top layer. You end up, quite frankly, paying more than what you would have kept because there's friction, there's overhead of reinsurers, etc. Now, capital management perspective says, I am now an insurance company. I'm comfortable with my risk profile. I've done whatever I need to for risk management purposes, and I need to hold $100 of capital. Okay, $100 against limits that are 10,000. I don't know, some multiple of that. $100, right? And I only want to source capital that is $100 and not more than that. Okay, and so what happens is if you take the bottom layer of the capital tower and say, now you're not talking about risk. You're just saying I hold $100 of capital, and which ends up being some small fraction of the reserves or a small fraction of the premium. But I'm going to go out and say I want, you know, you know, $30 or $40 of that. I'm going to go into the capital markets. So they raise $30 or $40 of capital. That system doesn't mean that there's more capital overall. What happens is when you're going into the ILS market for top layers, you end up over collateralizing, because if that top layer was kept inside of an insurance company, the amount of capital they would attribute to it would be a fraction of the full limit. Whereas when you go into the cat bond market, you collateralize the full limit. But when you do a bottom layers, that's less the case. And so, you know, I've gone through an exercise where I've tried to optimize, like, where in the capital tower should you source capital on a collateralized basis, and it's always the bottom layers, because the bottom layers are less fungible than the top layers, right? I mean, you get the maximum diversification benefit on the top layers,
Right.
On a balance sheet. You know, if something has a 1% chance of happening, and you have 10 product lines, and you have 1% chance of something happening bad on 10 product lines, they're not all going to happen. And so you hold enough capital for maybe 1 or 2 product lines to go bad, not all 10.
Interesting.
But when you get to the bottom,
can
you
I-
actually have to hold something
meaningful
across all the product
Yeah.
lines.
So can I just make a point here? Just let me put this in my words, because I think this is a pretty important idea, and it comes at something that I like thinking about sometimes, which is to say that capital markets are actually not very good at tail risk, right? Because
Correct.
Because they, you know, you look at options.
They're not efficient in
Yeah,
terms of tail
because
risk.
they don't want it. Or they don't want it because they only have to put capital up against this one shot tail, and it's like, you know, what you want to be able to do is you want to be able to put all the tails into a pot, right?
Yeah.
That can fund any one happening, and now the diversification risk is at its most powerful, right?
Yeah, that is the most efficient. And so from a capital perspective, you're right, collateralization is less efficient than a balance sheet, always by definition. But the difference here, the offsetting factors are that it can be, on a long-term basis, a lower cost of capital, and there can be more of it. And both of those things are actually what's been, from my perspective, big issues in the insurance industry. One is the protection gap. You know, we were saying, like, I used to work for AIG, and even AIG, a big company, you know, couldn't offer limits above a certain, you know, there were insureds who couldn't get as much insurance as they wanted, notwithstanding the fact that you're a big company. And so going into the capital markets helps with that. And on a long-term basis, it should be cheaper because, and there are a bunch of reasons why it can be cheaper. One is that, first of all, it can be, right now, the risk is not traded. I mean, equity is traded, but really you don't have a very transparent, liquid market for insurance risk. Insurance risks are very opaque.
Yes.
And this is the reason why, this is the main reason why insurance capital is not a commodity. Capital is a commodity in most industries. Insurance is one of the last large industry where capital is not a commodity. And the main reason is because risks are not transparent. And there's a lot of middlemen. Like you said, you have to go to an actuary. And the fact is, even if you can go to actuary, if you go to 3 different actuaries, they give you 3 different answers. Right? I mean,
Sure.
Even though it's a profession,
Or 6
it's
different
science,
answers.
I mean, all of those things hurt when you're trying to commoditize capital. And so transparency of risk and liquidity, which would then create true liquidity, being able to trade it. You know, the reason why people say I want my capital back is because they can't really, there isn't really a secondary market for these things like there is for most other robust sort of asset classes. Like, you know, and I compare this to the credit markets. The credit markets create the precedent here for ILS. Remember, banks used to be just like insurance companies. They used to warehouse risk. They were very opaque, very relationship-based. And securitization opened those markets up. And what happened as a result of securitization? Consumers were able to access credit in much more, like right now, you and I can just go on a website enter some information and get a loan. We don't even have to go to a bank. And who's the person who's going to give us the loan? Somebody else. Like I could borrow something and you could be the guy who's lending me the money. And so access to credit has benefited society and through securitization, through commoditization of credit risk capital. And one of the key factors that allowed for that transformation is standardization and transparency in credit risk. Using FICO scores, for example, created a great standard and made things transparent. And at the portfolio level, using when JP Morgan's risk metrics team started using stochastic VAR as a way to manage portfolio credit risk, that allowed people to take portfolios of credit risk, understand the risk, rate it, and then trade it. This is the same opportunity in the insurance side. Is if we can make this risk transparent, we can go into a much deeper capital market, and not only can we bridge the protection gap, but I think that it will make this entire thing much more efficient. You can have cheaper insurance and you can have more of it.
Yeah, so let's a few things in there again that I'm very happy. I mean, you're almost predicting the list of things I wanted to talk to you about. So one of them is this liquidity of insurance liability. So I think that's a huge idea. To kind of ground that in some transactional, because reinsurance people listen to this. The hit rate for lost portfolio transfers is very, very low. I mean, how many of these things as a reinsurance broker in those days of my career did I have a go at and they just never turn out? I mean, they do sometimes, of course, but very rare because of the information asymmetry is always my explanation as well. But it very much is a lack of a market, or a lack of especially if you compare it to other asset markets, as you're pointing out, there isn't any liquidity insurance liabilities. But to me, like the lesson I take from that is to wonder, why we should presume that we can create liquidity and liabilities anywhere. I mean, to me, like we got to take that seriously, right? And I see with property risk, I see a way that we've gotten through that through the most extraordinarily successful insurtech boom of the last century has been cat modeling, right? Because that's created some transparency into risk, and it's the simplest form of cat model is you stuff on a map, right? And just pretend a hurricane and how much of them do you lose. Right, so you can actually see where it is, and you can actually get some insight into the risk characteristics of the portfolio. Maybe not so much the underwriting characteristics, but definitely risk characteristics, certainly in the tail. And that allowed some liquidity to occur, right? I think that's unlocked a certain amount of liquidity because we have transparency in the risk. But such a thing doesn't exist kind of anywhere else. And so if I come to your, to Ledger, which focuses on liability lines, and I know it's a bit broader than that. I'm probably overly narrowing it, but you can tell me how you want to characterize it. But presuming to be able to create some kind of liquidity in the capital structure, to me is incredibly ambitious.
Yeah, it may be ambitious, but that's what startups do. They have bold missions.
Yeah.
The question is,
I'm a supporter, by the way.
Yeah, can you do it? And so we're doing it actually, and let me explain how you get transparency. First is getting information on a real-time basis. Okay, so when our transactions, to date, all of our transactions have been with MGAs, going through fronted carriers. And what we do is connect into their policy and claim admin systems directly. And so every day in a completely automated fashion, we have the same information, meaning that our investors have the same information that the underwriters and claims adjusters have. So same information at the same time. Okay. This, by the way, there's also a precedent for supply chain. This information connectivity in other industries. The supply chain industry in manufacturing, supply chains became more efficient when they were able to link up when somebody pulls a product off a store shelf. If the retailer has the information, and then the wholesaler has information, or if the warehouse has information, then the manufacturer has information, and the supplier to the manufacturer has information. If everybody has information at the same time, it reduces the risk to the last person in the supply chain. We have something like that here in the insurance industry. Somebody writes the risk, and then several steps later, somebody actually provides the capital, and there is a huge gap there in terms of time. Even on CAT, the fact is that I'll tell you a quick story about this thing, and then I'll come back to the other point. So I used to work at Validus, and Validus, the founding team, in fact, had done a fantastic job of getting all of their CAT modelings run every day. Okay, so on a real-time basis, they had this information of their PMLs from the night before. This is a while ago. They did this.
Yeah.
I think probably the first or among the first. And they would, in those days, they would go around with their BlackBerry and they would show rating agencies, look, we can, we're really on top of risk. Now, what people didn't realize, of course, was the data that they were getting was from companies like AIG, which had data that was 9 months stale.
Yep.
So the fact that they were getting information on a real-time basis now. So what we have an opportunity now to do is that on non-CAT lines, CAT it's less important because nothing really happens. But when you're doing auto or workers' comp, every day the loss ratio moves. And I used to, on the first transaction, I used to have an app on my phone which would tell me exactly what happened the night before. What was the loss ratio? What was the claim count? All of that information happens real time. So that's one part of it, is information on a real-time basis is needed for commoditization. The second part is analytics. The analytics in the industry has been based on actuarial science, and actuarial science has done a fantastic job of creating a fantastic common good for society over more than 100 years. However, because it's a profession, by its very nature, it is subjective. It's two different actuaries, two different actuaries will get two different results, even though they use a scientific process, and that's not great for commoditization of capital. It's a little bit like having two economists, sort of have different views. However, over the last 10 years, and actually when it comes to predictive modeling, longer than that, we have started transitioning from actuarial science to much more modern statistical tools. People like to throw around the term AI too much, but let's just say it's much more modern statistical methods that can in fact be back tested. So the methods that we use, we have data for the entire industry for the last 30 years. So if we have a model that forecasts, for example, commercial auto liability, we can backtest that model on thousands of insurers over the last 30 years and see how well it works. We can't do that with an actuary. So if you go to an actuary today and say, tell me what your forecast is on commercial auto for something, I can't backtest that actuary, right? So that was not an opportunity 10, 20 years ago, and that is an opportunity now. So when you mix real-time information with more objective and transparent in the modeling itself, notwithstanding the CAP models have, the market has gotten used to CAP models, but the CAP models themselves are, quite frankly, very opaque. They're proprietary black boxes.
Yeah.
Right, and they really can't be back tested. Like there are times when you can sort of simulate prior events, but you really can't truly back test. It's a back test in sort of air quotes. So compared to that, the modeling that we're doing, and our modeling is not proprietary. We give it away. In fact, we also, to the extent that investors have the capability, we not only give them the input data, but we give them our Python code or our code and say, look, if you want to rerun our math and we produce a risk report. That level of transparency and replicability has not existed in the insurance industry ever. And there were no incentives to create that transparency, because that transparency benefits the ultimate capital provider, who can now provide capital more effectively, and therefore also the insured, but it doesn't really benefit all the middlemen in between, right? You and I, and we've all been middlemen in between. and middlemen make more money the more opaque something is. And the more bespoke it is, the more it's based on relationship, the greater the value the middlemen have. And so this issue about creating liquidity or real-time information is ambitious, but it's absolutely doable. We're doing it now. I mean, you can see on the portfolios that we've done every day what's happening, and it will create the conditions for secondary trading. Whereas for CAT, even though there's some secondary trading on CAT, it's really mainly for liquidity purposes. It's not because people have different points of view on what's happening, because there's nothing actually happening. You don't getting real-time changes in exposure or real-time views on the underlying CAT risk. But if you were holding an auto portfolio or workers' comp portfolio during the pandemic, you could get real-time information. You could see that the frequency was going down, and you could capture some of those gains and trade it with somebody else. That is not only possible, we're doing it. And so that makes insurance look more like credit and follow that precedent in terms of commoditization of capital.
So if I'm an underwriter, I'll tell you what I don't like about that story, right? By underwriter, I mean like, reinsurance underwriter, or even an insurance underwriter for that matter, where I'm going to say, listen, Samir, that sounds good. I agree with the earlier quote or version, earlier comments you made, which said that the revolution in the capital markets for, let's say, credit, secondary market for credit, was precipitated by a behavioral score, which is the credit score. So the credit score is this thing which is designed to measure my propensity for repaying loans, and it's like alleges to or arrogate, to like tell a disinterested party how trustworthy I am, right? It's a very human institution, the credit score. Like it's a profoundly, like, I don't know, it's almost like a dystopian controversy. I mean, people don't talk about it like this, but that's how I think of it. It's like, this is a score which represents how good of a person I am from a bank's perspective. I mean, there's like a morality embedded in a credit score, right? And we have no such thing in insurance, because insurance is like a different kind of moral behavior. Because like, it's not just a default on a loan. Like the purpose of insurance is the default on the equivalent of default, which is to take a claim under certain circumstances, right? And so there's way bigger gray area for what good behavior and bad behavior are, right? So it's like way harder to do, and we don't have one. We don't have a proper insurance score. I mean, people will hack away at the credit score and give you an insurance score, but the basis is too far off that there's no such thing as a true insurance score. To like, like I like to joke about my father-in-law, he would probably never submit an insurance claim under any circumstances, just that kind of person, right? House burns down, he'll rebuild it himself. I don't want to, and some people are like that, and other people, are not like that. There's whole segments of the marketplace where, all you're doing is fighting with your insurance all the time, highly adversarial relationship. We have no way of capturing that in data. Goes my underwriter's response to your point there. And so absent that data, we will still need underwriters. And so, if you're not measuring the right thing, then you're not measuring anything yet.
Okay, a couple of things. One is, when I brought up the FICO score, I wasn't using it to suggest that we should have an insurance score that dehumanizes people into numbers or anything like what's been. None of that is needed in order to make my argument about the value or the ability to rate risk. What I'm doing is illustrating the role that transparent real-time information and transparent analytics has in getting investors comfortable with risk and rating of the risk. Rating of the risk is important. Now, and most of what I'm also talking about is portfolio modeling, because that's where investors provide capital. Whereas in credit, they actually, because it's an asset, you can actually match up one loan with one borrower with one lender. Here you can't, right? So we're talking about at the portfolio level always, never at the individual level.
Yeah, and can I break in for 1 second? Just say a really important feature of insurance is it's the trading the promise itself is really hard, right? So
the promise.
Yeah, so like the novation of a policy and transferring it to another carrier, like that is freaking hard to do. Whereas it seems like in capital markets, you have to have the servicer.
It's hard to do because the information is opaque and the analytics the methodology is not reliable. I mean, those are two issues, but those are not unsurmountable issues. There's no way that um, um, that you need to keep it opaque in order to provide a good and be able to rate risk. There's, that's not an inherent requirement in assessing insurance risk that it be kept opaque or that be made subjective. The fact is that the gathering of data and improving the reliability. I mean, there's millions of examples of this stuff. Notwithstanding the fact that FICO sort of made dehumanize people just simply because how successful it was ended up being used too much for the wrong things, and.
Sure.
But that's not a problem with the fact that there was a FICO score.
Yeah, and it's still being used effectively. I don't want to be too critical of FICO, by the way, because I do kind of believe in the optimistic version of that financial revolution. The picture you painted earlier was one of FICO's success, which I'm on board with. There are some implications about that, philosophical implications maybe we're a little uncomfortable with, but to me that's part of the trade. We got some outcomes. I just want to be clear, like I'm supportive of the whole idea.
Yeah, I think it's good to have these debates because you're right. This is again, I love the fact that you started from a consumer perspective. A lot of times these dialogues start that I have are about, well, what does this do to reinsurers, and what does this do to
nobody cares about reinsurers,
NGAs.
Samir. They don't even know they exist.
Exactly. We should start with the most important people, which in fact there's two customers, I think. The people who have the risk and the people who have the capital.
Sure.
Most of the conversation is about the middlemen rather than those two endpoints, and we have not been servicing those two endpoints. But here, I think that predictive modeling, as an example, has grown, right? I mean, we can't deny the fact that predictive modeling has grown. There may be some people who want to debate whether it's ethical to use predictive modeling, and and what factors go into that and all that. But the fact that you can do predictive modeling and the growth of that, is going to benefit the insurance industry. The same kind of thing happens at the portfolio level, which is where we're focused on. We're applying the same concepts, but at the portfolio level. And notwithstanding the fact that not everything can be modeled, but I think right now to think that you absolutely need an underwriter, a person can better process risk with their own biases rather than a mathematical model, is sort of dismissive of all the problems with people. I've worked with underwriters a lot, and there's all kinds of biases in underwriting.
Yep.
and you can eliminate those biases. Now, math has its own biases as well, so I don't want to dismiss it. But my point is that the difference between the two is that math can be made, you can backtest it, you can make it transparent, you can lay out the logic very clearly and let the investor gauge the strengths and weaknesses of that math and price the risk, which is what they're doing right now in the ILS market. They know AIR and RMS and EQER are not perfect models. They have sort of understood the strengths and weaknesses, and they price through that. Good investors can price through. Good investors don't need a perfect model. They need a very transparent model that where they can gauge their strengths and weaknesses, and they will price it. And I think the same thing applies in non-cat risk. In fact, more so in non-cat risk, because in non-cat risk, things move every day, and you can, one other point to make here about non-cat risk is the structures that we use are all based on loss ratios, accident year loss ratios. Remember, and we do quota shares because we're doing it at the bottom layers of the capital tower, not the top. And so what the investor is betting on is loss ratio. If you look at loss ratios in any product line for any insurance companies over the last 30 years, and we've done that. We've looked at all, you see that they generally trend from year to year. They move up and down in trend, and they mean revert. Okay, right? I mean, we all know that loss ratios can't get too high before they come back down. They can't get too low. They have to come back up. So that's a fundamental dynamic of this industry. The fact that loss ratios trend and mean revert, as opposed to cat risk, which can blow up on any day,
can I actually push back against one part there, which is to say that I agree with you in the aggregate. At a I don't know, some high level of aggregation, they mean revert, but
the company level they do.
Okay, which is still a pretty high level of aggregation, right? Because you have a portfolio. I mean, companies kill divisions. They kill divisions. Like they will eliminate a portfolio because
agreed.
I don't believe this can make money anymore, and off it goes.
Yeah.
Right? Companies go bust occasionally as well. So I'm thinking imagine the S&P 500 stock index, right? So the index goes up and up and up, but some companies come in and out, right? So the composition can change of the loss ratio over time, and if you pick the wrong horse inside of that composition, you can still lose.
Yeah, if you're picking horses. But first of all, the fact that divisions can be cut supports the idea that loss ratios can't go up forever. If loss ratios are going up and you're not able to figure it out, either you bring it down or you're dead. Right. And so you're out of business. So there's no, so it goes to somebody else who is more skillful in that. And so the point still remains is that loss ratios trend up and down and they mean revert. And as an investor, I think the opportunity now is not to seek alpha by picking specific underwriters and trying to gauge who's better or worse. The opportunity is to get broad access to this risk, which creates alpha in the sense that this is diversifying risk, which is the only free lunch you can have in the capital markets, right? This is the law of large numbers, and the idea is that if you get a good cross section of industry of risk that mean reverts, and you're in it strategically for a long time, and the information is transparent, and the analytics are objective and reliable and transparent, then you have all the conditions for a commoditized market.
Well, you wind up with an insurance company and another kind of characterization of that. And I want to come back to, there's a few things I want to make sure we touch on before we run out of time. Hopefully we'll make it to them. So one of them is, you mentioned earlier about cost of capital advantage, right, for capital markets. And here's something that bothers me about that, which is to say that the pension funds, let's just call it pension funds, the ultimate capital providers, are cheaper in writing cat bonds, let's say, than they are. But they're the same people who are buying the equities. So why are they given a better deal out of this side of the house than that one?
Yeah, it's a good point. So it gets to the question of what risk are you taking when you buy equity versus when you buy ILS? When you buy insurance company stock, the fact is that you think you're buying something that is insurance, so it should be diversifying, but the fact is stock prices move up and down with the market. They usually have a beta close to 1. So insurance company stocks are not the diversifiers that you would think they are. But if you buy a cat bond, that would have a beta of 0 compared to the broader asset classes, to interest rates or stock markets.
Are we sure about that? So let me kind of push back on that idea, because I wonder how much of that is just sample error. Because if you look at the financial crisis, right, you had a liquidity crunch in cat bonds, right? You might say, well, that's not because of the underlying risk. But I would say, well, hey, too bad. The prices still dropped. And because it's showing that there is asset market correlation. Because if I think about insurance company, the proper correlation to me would be between insurance company results and cat bond results, as say earnings, right, as opposed to asset prices. Because you know what I'm getting at, right?
Yeah. Look, I agree. So let me. In fast-moving markets, in the end, all prices are correlated.
Right.
That's the point you're making. I agree with that. Okay. However, that doesn't change the fact that we talk about correlation as if it's sort of like one number that applies all the time. It's correlation in different markets, right? It's more like a copula. It's like correlation in fast-moving tail risk scenarios as opposed to correlation in normal day-to-day markets. And so the thing is that the price of these insurance-linked securities, the underlying risk, which obviously affects the performance as well. There are two things that affect the performance: the underlying losses and then the price of that risk. So the price of that risk can be correlated, but the underlying losses are not, right? And so in normal markets, it provides significant diversification benefits. But in fast-moving sort of tail risk scenarios, ultimately all prices will move together.
So, but if you wind up, your vision's realized, right, and you're saying now we have a index of the market at a certain layer of performance through that, where you're most capital efficient, why would your results not be the same as an insurance company earnings? And so not command any difference in capital cost.
Yeah. So I think this is why I think that insurance. One of the reasons why insurance company cost of capital is high is, like I said, it's very opaque. I was a chief risk officer for the global, for a couple of different companies, and it was hard enough for me to understand all the risk and then be able to explain to my management team and then to explain to the board. The investors don't really, with all due respect, the investors don't really have a clue. And it's because they don't have information and they don't, they trust middlemen. And I think just that, that if anything happens here, even if you keep everything inside of an insurance company, if you can give information on a real-time basis and use methodology that is more transparent and reliable and more objective, that will decrease the cost of capital even inside of an insurance company as well. And so I'm not suggesting that the construct of an insurance company is itself inefficient. I'm saying the way insurance companies are run now is inefficient.
That's super interesting, because there's another thing that I wanted to make sure we touched on, which is to say, it was observation that I make. And, one of the things I like to say is when any company hatches an initiative, particularly one that says, let's go to the capital markets because it's cheaper capital, right? And I say, but here's one thing we need to keep in mind. What are we going to do when the traditional market beats the capital markets on price? Because that's something you see all the time, right? They'll say, we'll just be cheaper. And to me, like, why we should take that seriously, where they, you're telling me a story now for why the traditional markets could do so, because their cost of capital for such a risk is the same as the capital markets, because the capital is ultimately the same. And if they have transparency into the pricing, then they should be just as cheap.
That's one part of it, but I'm not done with that. And so that's one part of it.
Carry on.
Okay, so that's one reason. However, there is inefficiency in the value chain because we all know that I think we all acknowledge now, because I hear everybody kind of been saying it for the last 5 years, there's too many hops in the insurance industry. There's too much friction to get to its capital. And so we have a lot of overhead. So what happens is, let's say that you have a big insurance company that uses the MGA. The MGA is doing the underwriting and they're doing the claims, but the insurance company has their chief underwriting officer, they have a chief risk officer, and then they reinsure some of it, and the reinsurer has a chief underwriting officer and chief risk officer. And everybody is remodeling that same risk in order to manage their capital. But if everybody had the same information chain, if everybody was plugged into the same information chain, and the modeling was done once, then you can have many different layers of capital. It wouldn't create that overhead.
Right.
And so that's another problem with the current construct of the industry, is that there's just way too much overhead, and again, to the benefit of all the middlemen, but not necessarily to the benefit of the insured or the capital provider, and that's a lot, actually. I mean,
But let me try and tell a sympathetic story on that one. So, much earlier on, you mentioned at the very beginning of our conversation, we talked about how there's this, I forget the word to use, ecosystem of promises, right? That supports the initial promise of an insurance company. And I'm with you on that. Now, to me, the promises are trust but verify, right? And so, you're talking about duplication of effort. I'm saying, sure, but that's how you know, right? You measure the same thing a whole bunch of different times. And so each of these, think of the ecosystem of the insurance industry, the capital structure, right? So, I had a conversation with Terry Vaughn, ages ago on this podcast. Let me put a link to that, where, I made the observation that there's regulators, there's rating agencies, there's reinsurers, right? And there's even like agencies and stuff who are always assessing how people are doing, are you doing your job properly? And they're all kind of doing the same thing, which is to say, are you properly pricing your risk? And one of them can fail, and often one of them does fail, right? Or even two of them. Yeah. But you have so many of them that somebody's going to blow the whistle, and then, or even investors are looking at this stuff, right? So, duplication of effort, sure, but diversification of oversight.
No, I don't think there is that. So here's why I think that, because I think it would be right if everybody was using the same information and had access to the same information and was redoing the same things, but they're not. The fact is that, I recall that, when I was in AIG, there were times when I would go out with a field engineer who would go to a building that we were underwriting, and we would go to the roof and we would walk around the roof and we would check all these things. There's a lot of information that was being gathered there to underwrite that building. When it was reinsured on an XOL program or a CAP program, they didn't have that information. There's no way they had that information. They had aggregated level of information, okay? And so what's happening is that at each layer, they're getting aggregated information and they're doing more portfolio analysis. It would be better, wouldn't it be better if everybody got the same information and you still had the same number of people? So you have rating agencies get the same information, the regulators get the same information, the capital providers get the same information, the insureds get the same information, and you have one set of analytics and everybody knows what the strengths and weaknesses of the analytics. That would be consistent with what you're describing, having many eyes reviewing sort of the wisdom of the crowd sort of approach to looking at the same information and coming to some conclusion. That would be valuable. But right now, you don't have that
well, I would say, so I'm with you on that comment, but I would broaden the concept of information here, because reinsurance underwriters, they have a job. Many of them are very good at their job. I mean, they don't necessarily, even if you gave them all that information, they don't know what to do with it, right? So what they do instead is they evaluate the people. And same with regulators, or rating agencies. They sit down, listen to a presentation of the CEO or whomever it is, and they'll pepper you with some questions and see how you do on those questions. That is a different source of information. It's like an aggregated, obfuscated information about the portfolio, but it is a distinct source of information, right? Do I trust them?
Agreed. Yeah, so they may be coming at a different angle, but are they also evaluating their compensation plan and their bonus pool, and to what extent they get promoted if they say no to a risk if it doesn't meet its requirements? They're not doing any of that, right? So when you're evaluating an underwriter, you're not evaluating the entire system under which they are being underwritten.
No.
And those are very different from company to company and from underwriter to underwriter. And first of all, that will take a lot of time, and there's a lot of subjectivity in this analysis. If instead, again, if you had something that was objective, if you had the same information that the underwriter had, you don't have to evaluate the underwriter. You can evaluate the
underwriter's decision. You can Monday morning quarterback them.
Well, it's not Monday morning. It's got to be better if you have all the same information that the underwriter has, and you can not only analyze the information, but then you can also analyze the underwriter's reaction to that information. So imagine, like, on our deals, we have an MGA that's connected up to a capital provider. If the MGA has underwriters, right? So now the capital provider is able to see that information, is able to see how the underwriter reacted to that information, or the claims person reacted to that information, and what the net result is. That is much more effective overview than simply saying, I don't know what it is, but let me look at your CV, and you have a great reputation.
Well, I mean, so another way of putting that. So again, I'm inspired by the depth of the ambition here, right? we'll be able to like atomize an insurance company's portfolio, analyze the decision-making process in a granular fashion, and then reaggregate it. Holy cow. But let me kind of tell you something
Well,
that's
the
come to mind.
insurtech MGAs are doing that now, right? I mean, they're getting information on a real-time basis.
Yes, but I'm talking about evaluating an insurance company. But anyway, yeah, I'm not disagreeing with you. The thing that you gain to me with this is, or the way around that, if you're a regulator, a rating agency, or a reinsurer, is you look at you mentioned CV. Another way of saying, look at the track record, which is why it takes so long, right? Sometimes, where it's why you have to trot out somebody who's done it before in order to get that A rating out of the gates if you want to start up a new company, because now you're kind of pinning your track record to this. And if you can sustain a track record over time, your point there about analyzing compensation structures and like the innumerable features and variables that go into successful insurance, that all is too hard to do for a human. So instead, we just say, okay, well, I'll just fold my arms and I'm going to wait 5 years and see how you do, and then you can come back, and then I might give you what you want, right?
Yeah.
Which is a very long time.
Okay, so let's look at track record now. Would you rather have going to invest in a portfolio? Would you like to see the track record by actually seeing the losses and the premium of that portfolio for the last 10 years? Or would you like to see the profitability of the company that was insuring that portfolio?
Well, of course, you'd like to look at the risk, right?
Yeah.
If you can find a way to aggregate the risks.
But you are getting a track record here.
Yep,
but
sure.
You're getting the track record of the thing that you're investing, again, rather than a proxy. So all these discussions about evaluating the underwriter and all that, which is the best we can do now.
Right.
It's being done because that's the best we can do, not because that is the best way to do it. And the reason that's the best we can do is because they don't have access to information. If I was a reinsurer, look, I don't want to talk to the underwriter. Show me the loss ratios and show me the detailed loss runs, show me the premium, and show it to me over the last 10 years. That tells me something. And show that to me not only for your company, but for every other company. Now that tells me not only what you're doing, but how you're doing compared in a competitive market of other companies. Mm-hmm. All that is available now. It's available, and it's not being, certainly it's not. Look, even in the example you're providing, who's doing that evaluation? Is it the person who's providing the capital? No. It's the capital. The person who's providing capital is trusting some management team.
Yep.
And that management team has a hiring underwriter who's trusting another management team and their underwriter, and they may be trusting an MGA. Okay, so it can't be more efficient than the capital providing getting the information that's at the front of the line.
Well, certainly not. And in fact, so here we're kind of rederiving a whole bunch of cultural features of insurance, right? Where we're saying that, if the original sin is information opacity, then the only way to evaluate strategy is to wait and see how the strategy goes, right? And now, like if you're an underwriter that has a good track record, that's a precious thing because it's a very expensive thing to build in terms of time. And so now you're not really willing to change too much about it or take risks, right? Career risks, strategic risks, because if something fails, now that's pinned to your forehead and you got to live with that for a long time. And so it creates a sign of, would in this kind of like conception, tell me what we think, but create a kind of, inertia that fights against change or doing things differently because, it's too expensive to recreate a track record with something new if it just goes wrong, even by chance.
Yeah, I agree that there's a lot of cultural inertia in the industry. So, but I'm not thinking that that's necessarily a good thing.
Well, yeah, I hope I wasn't coming out in support of it there. I was just saying it existed.
Yeah, it exists. So inertia exists, and so and that will dictate the pace at which new things are absorbed. But we also know that another dynamic of the insurance industry is, quite frankly, insurance industry has not been known to be leaders in innovation, but they are known to be good followers.
Yeah, they're conservative, right?
Yeah, they're conservative, right? And so, the ones who will lead this innovation are the ones who are going to make all the money, or make a lot of money, and then the rest of the industry will follow, and that's fine. when you're trying to drive change, in whatever system it is, you don't try to achieve change by going at the entire system. You only need 5-10% of the system to embrace the change, and that becomes a catalyst for everything else.
Well, I should say that there is one piece of the insurance, the conservatism, which I like or am sympathetic to, which is there is a certain amount of intellectual humility baked into this, right? Where risk is infinite. All kinds of crazy things can happen, and so that's a great idea. And one way I like to put it is, innovation is indistinguishable from underpricing in the short term, right? It's like you got a great idea, tremendous, but you might be blowing up tomorrow, and I just can't tell because I don't know enough about what's really going on. And so sounds plausible. Well, let's wait and see, right? And so like, I think that's a cultural feature that is a residual of like success. There's survivorship bias in there. I don't think that people want to be that way. I just think that those who have survived are that way. And a lot of the others, and not everyone, but many people who have great ideas are underpricing for reasons they didn't understand and explode,
Yeah, it's a good, So again, what's related to what you just described is I used to wonder, and we used to have debate with lots of colleagues about how much, when you're rating an underwriter, how much of that is luck and how much of that is skill.
Yep.
Right? Given the inherent randomness of the underlying process. The thing is, there are statistical methods to try and assess that, not like in a yes/no fashion, but in a degree. Using sort of Bayesian methods, you can you have a priori estimates, and you have new evidence comes in, and each time evidence comes in, it's like credibility theory. So there is a way to kind of to gauge what is luck, at least get some sense of statistically to what extent something is random versus something is meaningful. That's really the root of all these statistical inference methods, is to separate signal from noise in these things. I think from what we're seeing right now, at least with the investors that we're talking to, they value the fact that this is direct connection into risk, and then they value that they're getting information that's much more transparent and objective than other things that they've done. And also in the current environment, because there is so much overhead in the industry, it's hard. It's possible to get returns that are higher than what they should be for comparably rated risk, which is how the cap-on market was. Back in 2012, 13, 14, 15, around that time. I was fortunate to be in the market at that time. The spreads were much higher than what they should be. Eventually, they converge. And right now, we're in a similar environment that the spreads are higher than what they should be. And there's opportunities for investors to take advantage of that. And I don't expect that they will all do it, but I think only 5-10% need to try it. And then we'll see.
Well, I have to say, I have not covered everything I wanted to cover, but we are at time. So, Samir, anything else about Ledger? How any asks of the audience? What can we do to help you? What are you looking for?
I don't know. I hadn't really thought about a specific ask. I think that I'm hoping that people will appreciate and believe that it is doable, this idea that you can get information that is much more transparent, much more reliable, and you can tighten up the value chain. This is not, this is not speculative in that sense, that all of these things are doable, and people are willing to sort of at least look into it.
Great. My guest today is Samir Shah. Samir, thank you very much for your time.
David, my pleasure.